Today, folks, I want to talk to you about the destructive nature of you buying Canadian dividend stocks before the age of retirement. I know this is a very controversial statement as somebody that actually buys Canadian dividend stocks, but somebody with a global mindset, I think, can offer a lot of perspective, not as financial advice, but just to help guide you on the path to financial independence to perhaps one day retire early. And if that's a conversation you'd appreciate, hit that like button because this conversation was sparked by a very simple discussion in my WhatsApp chat group where somebody pointed out these two tickers, VFE versus VOO. Both are the exact same stock, but one is converted to the Canadian dollar. So if you're a Canadian citizen, you're scared to buy over the border companies, you can buy this one in literally a Canadian dollar equivalent. But we can see that the Canadian dollar equivalent is actually up 4% more than the US equivalent. Now, why is that? Well, because one hasn't converted the currency yet. If you bought US dollars and you bought VOO with those US dollars, you haven't converted it back yet. Whereas in VFV, it's auto converted. So we can see that the Canadian dollar has absolutely plummeted since the beginning of the year. It's down 4%, which actually equates to the extra 4% return in capital gains we can see from these two tickers, right? Now, if you zoom out even on a farther scale from 2021, the Canadian dollar is down about 12 to 13%. Do you know how crazy that is over a 3-year period? That means any US assets that you bought, even if you're getting US dividends, you've made an extra 12% return. You've got a 12% raise just by getting your money out of the Canadian dollar. Now, this hurts me deeply inside being a Canadian, considering how much this is stifling growth here. And a lot of this comes down to a political landscape and political discussions. It's become very controversial, very heated, very divisive, just like it has in the US between Trudeau, the Liberals, the Conservatives, the NDPs, and all this stuff, right? But you got to take a look because when we take a look at the markets and GDP, this is where the conversation really has to come into play. Since 2009, the bottom of the 2008 financial crisis, the S&P TSX is only up 183%. The S&P 500 is up 635%, right? When you look at GDP in Canada, GDP has really not gone that far since, basically what? I think 2013 timeframe. It's not that exciting, guys. I mean, you take a look, we've stifled for a few years, we bumped up, we've actually lost a bit of GDP in 2023. Even in 2024, like the forecast has been lowered for GDP growth. And you look at the US and the explosion in GDP growth. Why is there such a difference between these two economies? Well, it's basically because of companies. Companies drive GDP, right? Innovation drives GDP growth. It brings in foreign money, brings in foreign interest, all this stuff. So when it comes down to this political divisiveness, we have our Canadian government that they're kind of playing Robin Hood. They're trying to take from the rich and give to the poor. They're saying they're introducing a new capital gains hike to start, but Canada needs more revenue. Basically they're trying to generate revenue by taxing the lower 1%, and they're increasing the inclusion rate of capital gains. I'm not going to explain the complexity of that, but you have to understand that we need big business here because that's what employs people. That's what allows like all these immigrants to come in, get jobs, and be able to afford the insane housing market that we have here. And they're really stifling that. And then we also have obviously the Conservatives. They've been attacking the government's carbon tax, releasing data that impacts what impacts carbon tax is having. The data forecasts lower emissions but also lower GDP under carbon pricing. Now, Canada, I don't think should be doing carbon tax. I think it's insane. They've been in an inflationary environment adding carbon tax to our gas, which increases the prices of food, housing materials, everything across the board. Yet they're saying it's helping people. They give obviously carbon tax incentives. If you buy and upgrade things in your house, like your heating to a more carbon efficient heater, the government will subsidize it and they'll help pay for a huge majority of it. And it just seems silly to me. I mean, I don't get how you can stifle the entire economy to benefit a subsection of it. But they're saying they're helping Canadians that need it, which again, I don't like this Robin Hood approach. Now, Canada does want you to be rich. I think Canada is one of the few countries that actually really wants you to build wealth because we have way better tax advantage accounts than the US has. We have TFSAs where in perpetuity for the rest of your life, you can make tax-free income. Outside of withholding tax, because if you buy US dividend stocks, you'll get a withholding fee, but not on capital gains. So if you buy VOO, you get a lot of gains, and you get those crazy 600% gains since 2009. You can capitalize on that, pull it out whenever you want, as much as you want, and spend it 100% tax-free, not impacting your income bracket, which is crazy. Then we have the registered retirement savings plan. Now, this one, you can buy US dividend stocks, you can avoid the withholding, and you get tax deductions on the money you put in here. So if you pay tax on income, you put it in your registered retirement savings plan, you get the tax back, you get to perpetuate tax-free growth. And then when you pull it out, that's when you pay the tax. These two accounts can build unprecedented amounts of wealth as it has for me. I mean, the vast majority of my fortune has been built within these accounts, which is absolutely incredible. But what you need to recognize is you kind of got to get away from the Canadian economy to really justify these accounts. Now, I'm going to talk about that in a moment. And for those of you that are trying to buy a house, we now have the FHSA. This allows you to save up again, kind of like an RSP to buy a house, tax-free growth. It's great. And also, if you're trying to start a corporation in Canada and you're a small business, this is where you get rich as well. Not if you're big business anymore, but if you're small business, you can do pretty well because we have small, lower, or small business deduction rates. I mean, in total, you're paying less than 13% income tax on the first $500,000 made. So if you're under $500,000 in revenue a year, you're a small business. You can do a lot of write-offs, get major tax deductions. Canada is great if you're tiny, not if you're big. And again, that's the stifling problem, right? So when you look at like a bunch of different stocks here, and we'll talk about my portfolio and why I'm so oriented toward US stocks, you can see that like my two favorite kind of investments still tend to be dividend income. And I look at VDY and SCHD, my favorite US dividend stock and my favorite Canadian dividend stock, ETF, I should say. They're not individual stocks. But when you look at the difference in performance between what US dividend ETFs have done versus the Canadian ones, it's kind of uncomparable. I mean, you're talking about a 200% capital gain before dividend income versus the Canadian counterpart. We're only getting a 74% capital gain. And this all really just boils down to me, obviously realizing I don't want that much Canadian dollars. And we're very privileged that Canada lets you have tax advantaged accounts that you can buy over the border stocks, pay virtually no tax on any of the income or gains, and benefit greatly, which is why it's so prevalent that you get your money mostly out of the Canadian economy. And I feel like Canada has kind of this country biased and this investing bias where they tend to buy a lot of Canadian stocks. I see it on Blossom. I see it on all these different investing apps and Canadian investors. And I think it's a detriment to a long-term growth strategy because it's obvious and it's apparent that the largest and fastest growing companies are in the States. The US GDP is going to continue to grow faster. Canada hasn't really done anything, being the most commodity rich country on the planet, to actually like really push growth. I work with so many companies in mining and oil and gas, and they just talk about these complaints about policy and red tape they have to get through and how long it takes to start something, right? It's really kind of sad and annoying to see all that stuff. So again, like I take advantage, and even with my fiance's portfolio, less than 10% of our combined portfolios are sitting in the Canadian economy. And I know I talk a lot about Canadian stocks. I love the Canadian banks. I love a lot of these companies, but you really have to grasp the reality of what I'm doing here when I'm talking about Canadian stocks. Because again, most of my money, 57% of my invested capital, is in the US economy outside of real estate, because obviously the real estate we own here is a huge percentage of our portfolios. But that's why we take most of our invested in stock capital and equity capital over to things like SHD, VOO. I bought more Tesla today. I've almost got my Tesla shares where I want them to be, as I've been trying to get to about 100 shares at least starting. And that was what I set out at the beginning of this year. I said, look, I'm going to try and cost average anything below $200 a share. And I'm just going to keep buying until I get to about 100 shares. The stock craters materially, I'll probably keep buying more. If it starts to rally aggressively, maybe I'll take a break. But that's been my goal. I've got 91 shares right now. I bought more SCHD today in my RRSP so I can get that, tax-free, dividend income, 100% tax-free, reinvesting on itself, compounding over the next 5 years before I start probably drawing against it up to 709 shares there. I haven't bought any more VOO just yet, but I will obviously be buying more VOO in time. And I'll always be cost averaging into VDY as well. But VDY, again, the smallest percentage of the overall portfolio, because we got about 267,000 invested. We're up 32,000 in gains, and we've got about 5,000 in dividend income. And when I get to the age of retirement, which might be in 5 years, might be 10 years, 15 years, I don't know. Obviously, I want to retire early, but I'm going to obviously start redirecting some of this capital from the S&P and Tesla, and I'll probably start converting it more into the Canadian economy, more higher yielding stocks. But I recognize that in the meantime, to fast track that growth, I'm going to be putting it where the growth obviously is. And that's in the US markets, right? So you just want to be a little bit careful here with what you're doing and how you're investing and understand, global dynamics. I wouldn't really want to invest in China. China's cheap, but you're talking about communist controlled countries similar to Russia, similar to so many places out there. And it's just like, it's so glaringly obvious the growth that's going on in the US, and to not be taking advantage of it at such a young age would just, I think it would be detrimental. And it's not financial advice. It's just my perspective, what I see and what I implement in my own portfolio, which passed the question off to you. What are you doing in your portfolio? How do you feel about the Canadian economy? I'd love to know all of it down below.